Welcome back to EDS, and in this video I'm going to show you how to create a winning trading routine that you can use every single day when you log into your brokerage account. I'm going to show you exactly what you need to do. So the first thing is you need to pull up any equities underlying in your brokerage account. We've got Tesla up at the moment. We've got a position on in Tesla. Price seems to be coming close to our short call, but that's okay. Anyway, back to what we were doing. Tesla, any equities underlying will do, and then you want to navigate over to where you can see a list of expiration dates for that particular underlying. All equities underlyings have the same expiration dates, assuming that they're all fairly liquid. They've got the same expiration dates. That's why you can choose any one you like. Now, the one that we want to lock in on needs to be between 30 and 60 days out in time. And it also needs to be a monthly, not a weekly or quarterly expiration date. So the only expiration date that actually fits that criteria right now is January 17th, which is 31 days out in time. So we want to take that information, 31 days, come over to our watch list and simply filter out anything that has earnings over the next 31 days. The reason for this is because earnings will increase volatility. It will mess up our deltas potentially if the market moves after the earnings announcement. So we want to avoid these things, as these things will have a negative effect on our P&L. Remember, we're writing contracts, we're delta neutral. We're going to explain a bit more about that later on in the video. Therefore, we basically want the market to do nothing. If it moves up, it moves down, it moves sideways, it's fine, just as long as it doesn't move up or down too much. So we want it to basically stay where it is. Now, we also want to filter out anything with a low liquidity rating level. The reason for this is because we want to be able to get in and out of positions easily. We only want to trade tight spreads, not wide spreads. Every time you get in and out of a position, you're paying the spread. So the tighter the spread, the less you pay. Now, this is a pre-made watch list. You can use any watch list that you like. I personally like to order everything from high to low in terms of IVR. Remember, we are selling or writing these contracts. Volatility is a mean reverting thing, and volatility, the higher the volatility, the higher the premium on the contract. So we want to sell when the premium is high, i.e., when volatility is high, and then buy it back at a lower price when volatility contracts. And that's essentially the game that we're playing here. So we want IVR tells us where volatility is, or implied volatility, where it is relative to itself on that particular underlying over the past year. So high to low. We also want to keep in mind the size of the positions. I personally like to stick to positions on underlyings that are trading at least $40-50 a share. Anything less than that, it can get difficult to get good strike selection, unless if you're just doing one side, either a call side or a put side. Typically, if you're doing cash secured puts, it doesn't really matter too much. But for what we're doing, selling strangles, iron condors, that kind of stuff, more aggressive, um, more aggressive plays, we want nice strike selection. So $40-50 upwards. In terms of IV rank, 50 and up is good. Sometimes 20, 30 and above can be okay as well. It just depends on what the market can give us. And you also want to keep in mind the absolute IV level as well, which is different to IVR. So as you can see right at the top is Tesla. We have got a position on Tesla. We opened the position. Market has just shot up since we opened the position, but it's completely fine because it's still within our range. Right now could be a nice time to open another position on Tesla. We're not going to do that in this video, but just to show you an example, IV is very nice and high on it right now. MVO, we've also got a position on. UAL's got a very nice and high IVR at 87. It's trading at just under $95 a share. CVS is looking kind of nice. Oxy is looking nice. Palantir, again, we've got a position on Palantir. XLU, let's have a look at XLU. It's trading at just under $77 a share. It is an ETF. Therefore, we don't have company risk to worry about. ETFs generally have lower IVs, absolute IVs, but the IV rank is very good in this case, 61.3. Because we don't have that company risk, we will typically, if we're selling naked positions, we'll typically have lower returns. We'll collect less premium up front because IV is lower. However, I'm going to show you how you can increase your return on capital. So, XLU. What we want to now do is come over to our list of expiration dates and choose January 17th, which is the one we already selected at the start of the video. And now we can see the options chain. At this point, very simple. We want to do what we always do: sell one call, sell one put. And we want to sell them outside of the expected move, which is this vertical orange bar here. And that's going to lead to a high probability of success. Now, how far out do we want to go? I like to go anywhere between 15 and 20 deltas. So this is the delta column here. We've got a delta column on the put side as well. So between 15 and 20 deltas, we've got an 18 delta here at the 80 strike. And on the put side, we've got a 19 delta here at the 73 strike. So that gives us a positive delta on the overall position of 1.41. We want it to be delta neutral, i.e., the perfect situation would be a bang on 20 delta on the call side, 20 delta on the put side, or plus 20 delta on the call side, negative 20 delta on the put side, to be exact. And that would lead to a purely delta neutral zero, a delta of zero. However, a couple deltas is fine. It's not always, going to be perfect every time, but it's fine. And as you can see here, our contracts are sitting outside the expected move and just on the inside of these dotted blue lines, which is the one standard deviation mark, which is about where we want to be. And that's going to lead to a 68% probability of profit, which lines up perfectly with a one standard deviation range of 68%. And generally, as long as you stick to between 15 and 20 deltas, you're always going to land in and around this area, no matter what the underlying is. Remember, we are also product indifferent. We don't care what it is that we're trading. We'll trade anything as long as it's liquid, as long as it has volatility. So we will collect $79 upfront, which 79 cents times by 100, because there's 100 shares per equities contract. So that's $79 that we collect upfront. Now, you might be thinking this is quite a low amount of premium to collect. Remember, it is an ETF, so our P&L will be smoother, but because we don't have company risk, the market has priced this in, and the amount of premium that we collect is slightly less upfront. Our broker is going to require 1.2k in buying power to open this position. And now you might be wondering, typically we look at things with a return on a naked position of 10% and above. This is obviously less than 10%, but I'm now going to show you how you can boost your return on capital. So here's what you do. You pick a certain width, say $5. I wouldn't go lower than $5. You can go lower, you can go $3, but I'd say go with $5 if you can. So what that means is you want to count $5 above our strikes and below our strike on the put side. So 80, so $5 above would be 85, and you simply want to just buy that contract. Okay, you simply want to just buy that contract, and you want to do the same thing on the put side. 1, 2, 3, 4, 5, buy that contract. Now, what this is going to do is it's going to limit our loss. We are going to define our loss here. Okay, and how is our loss defined? Well, it's the difference between the spread, $5, take away the premium that we collect up front, times by 100 because of the 100 share multiplier, and that's how we end up with our max loss here of 448. And what's going to happen is our broker knows now that we have a max loss of 448, so it only now needs to hold that much in buying power. So if we remove the longs, we can see we have an unlimited loss potential. And then 1, 2, 3, 4, 5. Once we buy the longs back again, we have a limited loss. So now our buying power is reduced. Now, in this instance, because $5 is pretty far out in terms of delta, we're at 3 delta, we can go in a little bit. Let's say we go to a 7 delta. Do you know what? I'm going to show you all how to fit this into a very small portfolio. We're going to go $1 wide. Generally, I wouldn't recommend going $1 wide. However, in this instance, because of the way that the deltas are, a difference of 6 deltas on either side isn't too bad. It's kind of in line with what we want to do. Generally speaking, you want to be $3, $5 wide, but this is where the size of the underlying comes into play. For example, if this was Tesla trading at say $400, going $5 wide would be pretty pretty standard. I mean, you wouldn't want to go lower than five. I don't think you can go $5 wide. The minimum increments on strikes is $5 anyway. But going $10, $20 wide would be perfectly acceptable. Whereas you can't really go $10, $20 wide on this because it's just not a big enough product. So if you can go naked on this. However, if you can't, it's absolutely fine. You can go as small as $1 wide. Okay, $1 wide. We're going to collect $26 up front. And now, obviously, it's $1 wide minus 0.26, which is 0.74 times by the contract multiplier of 100. And that's how we end up with our max loss here. And our broker is only going to hold $74 in buying power. Now, the trade off with this is, so if you notice, we have a very high return on capital here. Okay, we have a very high return on capital here. We're going to be looking to make $26, and we're looking to put up $74. So very nice high return on capital, much higher than the naked position that we were looking at. The trade-off is we will have slightly lower probabilities of success. We were looking at 68% before, now we're looking at 62. However, if we want to get out of this position at 50% of max profit, we've got a 77% chance of doing that. So that's probably something that I would recommend anyway to do. It's gone up now to 77, 78. Generally speaking, you want to get out at 50%. Because this is such a small position, to factor in commissions and stuff, you may want to just let it ride out. At the end of the day, you've defined your risk anyway, so you've not really got anything to worry about. However, one last thing I want to go over is how do you know how much buying power you should be allocating to your positions? Well, to figure that out, we've got a free position sizing template. Link is in the description. Just click on this button. And the way that the template works is you enter in the size of your portfolio, and then you enter in whatever the current VIX level is, and everything will then be automatically calculated for you. At this point, all you need to do is use this information to form the backbone of your portfolio. It will tell you how much buying power you should be allocating, the maximum amount of buying power you should be allocating to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this, you'll be absolutely fine over the long term. Again, that's free. If you want to learn in more detail and see what we do and how we do it, again, link in the description. This time, click on EDS Premium and get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, the adjustments that we're making, how we're managing risk, all in real time. There is a full in-depth course teaching you everything that you need to know, so no prior knowledge is required. If you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee. So after 6 months, once you've studied the full course and followed our trades, if you haven't been profitable at that point, we will work with you for free until you are, or you can simply request a full refund. So there's no risk for you. And right now it's £1 a month. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. The mission of EDS Premium is to get you to a point where you can write contracts, sell premium sustainably, consistently, every single day, every week, every month, without any external help, any outside influence within 6 to 12 months. By all means, after 6 to 12 months, you're welcome to stay and be a part of the community. But after 6 to 12 months, you should be able to know how to do this all by yourself without any help. So that's the mission. And I will see you guys on the inside.